All right, welcome once again. And thank you all for joining us for our monthly webinar series where we bring in industry experts to give us invaluable insights and wisdom on various topics related to real estate investing. My name is Sohail Hassan, and I'm the co-founder and managing partner of Market-Based Capital, a private equity real estate development company headquartered out of Houston, Texas. And I'm, of course, joined by my fellow co-host and our guest for today's webinar, the Honorable Chairman of Markets-Based Capital, Dr. Masaki Oishi, affectionately known to all of us as Moss. And today we're going to focus on a topic that Moss is an expert on, and that is how physicians and other medical professionals specifically can create passive forms of income through investments in commercial real estate. And the reason I say that Moss is an expert is because he himself is a real life example of how a physician, in this case, a neurosurgeon, went through his own journey from managing his own practice and then becoming a successful real estate investor. Welcome, Dr. Oishi, and thanks again for joining us.
Thank you, Sohal. I really appreciate the introduction. I really wanted to address not just doctors, but really all professionals out there who have most likely the same sorts of concerns and worries about the future, and not just in building their own practice, but also in terms of developing, an investment portfolio for themselves. So, of course, we want to talk directly to physicians because I'm a physician myself, but I would also like to reach a wider audience as well. And please, you don't have to be a doctor to invest in real estate, or perhaps take a few words of advice from a physician. So I think my journey into real estate really started at an early age. I was about 15 years old when, my folks who came to this country as immigrants from Japan made their first investment in real estate. And they bought a couple of properties in a small town in New Jersey. We were living in New York City at the time. We couldn't afford anything in the big city. So they decided to go after properties that were a little more attainable. And they bought a couple of houses in a small town at the time called Fort Lee. It was right across the Hudson River, across the George Washington Bridge. And of course, because they didn't speak much English, and I was the first born of their children, the responsibility of taking care of those properties, collecting rents and making sure the property taxes were paid and the insurance was up to date, fell on me. And so it became, one of my standard responsibilities growing up to make sure these things happen. And so that was my baptism, if you will, into the world of real estate. The interest that grew out of that in terms of doing my own investment someday really led to various deals that I made through my own personal funds and experience. And when I moved to Houston in 2012, I invested in a multifamily property that did quite well. And so I decided after a few years of doing this that it was time to take the show on the road, so to speak, and syndicate, bring in other investors, and really go after bigger and more interesting projects, not just in multifamily, but also in terms of commercial malls, office space, what have you. But I think that was really a culmination of years of thinking about, what it is about real estate that was so interesting to me and so attractive. I think in retrospect, just like life in general, it makes more sense when you look at it in hindsight. I also had the opportunity to write a book recently called Prescribing Real Estate. And, I wrote this from a strictly a standpoint of a physician, really, uh, a professional who really has no, uh, free time to compete with, pros on Wall Street or other areas where investments are a full-time job. I thought to myself, what is it that a physician can do while focusing on his practice to also build something of a portfolio for himself and plan for the future independently. And that was kind of the impetus for writing this book. I'm actually more proud, though, of the fact that we were able to start a company called Market Space Capital. This was back in 2000, and was it 2016 or 17? So
17, 2016.
17, right, right. And at the time, Sohel and David Rodardi, our other partner, were even younger than they are now. Hard to imagine, but we came together and we shared a common goal of bringing real estate investment into the future and really changing the way we buy and sell real estate. I think we've remained true to that mission, and I think we're having a lot of fun and success doing it so far. What do you think? So,
Absolutely.
okay, that's awesome. Can we have the next slide, please? So, as I mentioned, I did author a book called Prescribing Real Estate. It is definitely written from the perspective of a physician who invests in real estate, but I don't want other professionals out there to think that it's only for doctors. I'm sure that all professionals share some of the same concerns and some of the same trials and tribulations in terms of building wealth for themselves and a financial future in which they can feel secure. And so I think there's a lot to digest in this book. If you want to take time and basically go at it at your own pace, this might be a way to at least get some insights into real estate, at least the ones that I've gained over the years. So I invite everybody to take a look if you have the time. My professional background, I think, is a little bit unusual in regards to that of a real estate investor or for a physician for that matter. I was born in the United States and I lived here until I was 15, but because of the situation with my family, my father moved back to Japan, and I moved there with him. I ended up finishing high school in Tokyo and also going to the University of Tokyo there, where I studied biochemistry and biophysics. I later applied to medical school in the United States, and I was fortunate enough to be accepted at Cornell University Medical College. I also did a PhD at the Rockefeller University, where I think I learned more about analytics and the study of all things, not just medicine, but also to approach things with a scientific and analytic mind. So I really do look back upon these years fondly. I think even though a PhD is not necessary in medicine or in real estate, uh, I don't regard that as time lost. I think it really prepared me to think carefully and scientifically about the world around us. Can we have the next slide? So, in terms of medicine, I'm old enough to remember a time when most physicians, thought about going out on their own and becoming a practitioner in their own right, opening their own practice, sometimes straight out of medical school or out of residency. And with that came certain responsibilities and certain investments. You had to have your own office. You had to hire your own people. You had to manage your own practice and business. Sometimes, if the practice did well, you would expand and bring on other partners. You would need more space and get more office space for your medical practice, or even buy an imaging facility like an X-ray facility or an MRI, or even a medical lab where you would run blood tests. And so, the progression for a lot of independent-minded physicians was to expand your own practice, and in doing so, it was almost a given that you would invest in real estate. You had to have space, and rather than rent your office, it was better to buy and expand your office from the inside out. And so, for a lot of physicians in previous generations, I would think that real estate investment came almost as a matter of course. Unfortunately, times have changed, not necessarily for the better, as far as I'm concerned. There are a lot of physicians who find that starting out on their own and starting your own practice is really a daunting experience, and I don't blame the new generation of doctors coming out of medical school or residency for looking at that and saying, "Look, it's too complicated. There's too much regulation and obstacles to being independent. I'd rather just join a big group, or maybe I want to be an employee at a hospital and just work as an employee, maybe 9 to 5 or what have you, and collect a salary." Now, there's nothing wrong with that. I don't begrudge anybody for choosing a lifestyle that suits themselves, but I've found that in a lot of these situations, uh, the opportunity to invest for one's own future is kind of lost. Obviously, if you're an employee at a hospital, you have access to 401ks, perhaps, retirement plans, perhaps, but that's really not the same as having your own investment in a property that is functioning and making money. There are a lot of benefits to investing in real estate versus just putting your money into an retirement plan. Uh, as the slide shows, there is the advantage of leveraged investing. Uh, if you finance a property correctly, you get a lot more property for your money, and the returns are also significantly enhanced. Uh, that's very significant in terms of generating the returns that most people need in order to meet their retirement expectations. Appreciation and cash flow, these are the twin engines of investing in real estate. Not only will a property which is bought strategically tend to appreciate in terms of its value, you can capture capital gains that way, but also if you are able to rent a part of it or all of it, it generates cash flow along the way, and it can pay for the financing of the property itself, along with things like property taxes, insurance, all the things that go into managing a property. What we found through our endeavors at Market Space Capital is that we can find properties that have tremendous potential and a track record so far of delivering returns routinely in the high 20% range. 28%, I think, would not be an exaggeration. So I think, yeah, sometimes even higher than that. And these are properties that are based in real assets in terms of real estate. That's an asset that will never, sink down to a value of zero, unlike things like junk bonds or certain risky stocks that are being traded. Real estate will always have intrinsic value. So I think that's something to consider. More recently, I think a lot of us have been, surprised and bewildered by the amount of inflation that we're seeing in our economy. You have to have been born before the 1970s in order to remember this kind of inflation. Uh, uh, Sometimes it's in the double digits. So again, real estate acts as a hedge against inflation, and I think that makes it a very preferable asset class to invest in today's environment. The tangible asset that that real estate is makes it something to hold on to rather than putting money in a CD where if the inflation rate exceeds the interest rate, basically you're losing money in real terms over time. In terms of tax benefits of real estate, we see things again in favor of investing in real estate. Depreciation is something that is very beneficial to people who have high income because you want to be able to offset some of those income taxes. We also see tax-free growth in a lot of these investments that we do, especially if the property is in an opportunity zone. There's, I think, a 10-year abatement on taxes. So if you're a high income, high tax bracket type of investor, there are investments here that are right up your alley, and I think that's something to consider as well. Cost segregation. I get asked about this a lot because people are very conscious about the taxes that they pay. I guess the simplest way to put this is cost segregation. It sounds really fancy, but it's kind of like itemizing your tax return. You can take a standard deduction on your income tax, or you can itemize your expenses. And cost segregation is kind of like itemizing the expenses that you have on commercial property, and it often leads to much higher deductions in the short run, so that you can take full advantage of the tax benefits of a property probably the very year that you buy into it. So, yeah, there are a lot of advantages to investing in real estate versus other assets. Can we have the next slide? So, one of the more intangible benefits of investing in real estate is community impact. And, I want to introduce a project that we recently closed on called the Tri-County Mall. This is a tremendous property in the suburbs of Cincinnati. I think there's a town called Springdale, which is really the municipality in which it's located physically. But it had been a place where the community would go not just for shopping, but also for recreation and also for socializing. And it had become rather run down over the years. And we were fortunate enough to speak to not just the people who wanted to renovate this property, but also to the community in general, the city council, and also the mayor's office, and come up with a plan to really revitalize this mall and contribute something that would make this community great again. I think that was something that we had in mind, not just in terms of return on investment, but also the impact on the community. Economically, of course, I mean, it's a huge project. The total impact of construction activities was estimated at over $1 billion, $1.2 billion. Construction-related job creation was also estimated to bring over 5,000 jobs with earnings of over $500 million. In terms of construction-related earnings tax, the city of Springdale also stood to earn tax revenue of over $24 million. And the new tenant operations, where we would bring in more tenants into the community with jobs and earnings, the economic impact of that was thought to be close to $400 million. So this was a big, big project. I think the economic impact of that was quite obvious. But what we also saw was impact on the community. We were happy to receive quite a bit of encouragement from the local education facilities, uh, the Science, Technology, Engineering, Arts, and Math Institute really was on board with this because we were going to create an education center for nearly 1,000 students annually. Education and young people are really the key to revitalizing the community. And, I think anything we can do to bring that about is a step forward for the future of any community that's looking to revitalize itself. Creation of a community center, a recreation center, was another thing that we did to ensure that this mall was not just going to be for shopping. This was going to be a place where the community can come together and socialize. I think that's especially important now that we're starting to lift COVID restrictions. We want people to be able to get together and feel like a community again. The environmental impacts of this mall are also something that we think about, and we also wanted to create hiking and bike trail systems that were eco-friendly and also allowed people to enjoy the surroundings of nature that were available. And I think in terms of creating jobs for the future, we also wanted to create a management and education incubator where we were training people in the fields of education, culinary arts, and hospitality management. I think this is, one of those projects that is a true all-around package. We have a template for this in Houston called City Center, where not only do we have residential housing, but we also have restaurants, shopping, and movie theaters. I think this integrated approach is really, I feel, the way to rejuvenate properties in communities that feel like they need to take a step forward in terms of infusing more investment and young people and their energy into the future. Well, let's talk a little bit more about community impact. We have been working quite diligently in our own hometown of Houston to take properties that have long been neglected or have been underserviced. One of the properties we are currently working on now is called the Huntington. This is, I think, in the Greens Point area of Houston. It is a underserved community, but we came at this project with the viewpoint of not saying, we're going to run a slum or anything like that, but we're going to take a property and we're going to make it nice. We're going to give people who live in these properties pride in the fact that they live in these apartments. As you can see from the pictures, this is we've done a very nice job of renovating each of these apartments. I think this is what, a 260 unit apartment. So
that's correct. 264 units.
264 units. So we've put money and effort into making these apartments a place where people would be proud to live, and that's can only be a positive impact on communities. So I think in terms of what we do at Market Space Capital, it's not so much that we pursue the bottom line. Of course, we do that, and I think we've done a very good job of that. But we also take pride in the fact that we do things for the community as well. And we also make efforts to reach out to investors who may not necessarily have the time to do all this on their own. We want our investors to know that we are coming from a place where not only do we look to make money for them, but we're also doing this in a very constructive way, looking towards the future and making all kinds of gains, not just financially, but also for the community. Currently, our internal management team has been working on projects. We have over $1 billion in assets under management. We have non-executive advisors who have experience in over $6 billion in transactions. And we also have our partners, our institutional partners that we do business with. These are industry experts and leaders in design, engineering, architecture, investment banking, etc., property management. We always want to partner with people who are the best at what they do. Our team members, I think, every single one of the people that we have hired is someone I can be proud of in introducing. Beginning with our leadership, Sahel and David Rodardi, but of course also with our associates, Thomas Matthew, this tremendous young man, has a tremendous mind for quantitative analysis. Kevin Sabuni, a more recent hire, just a very talented young man, really knows how to put things together. Taylor Stinnett, I think he is mostly based in Dallas. I don't see enough of Taylor, quite frankly. I think he's a remarkable young man with a very bright future. And our two most recent hires, the two Joshes, Josh Leonard and Josh King. These guys are going to be the future of real estate going forward. So I think we have a tremendous team. Also, our associate advisor, David Wallace, who does a tremendous job as well. I think we put together a very fine team of individuals, mostly younger than me, thank God. But I wanted to also discuss not just the people working for us, but the kind of projects that we've undertaken. Looking at our portfolio, I think our portfolio could probably be divided into two classes. One is the value-add projects, where we buy properties that already have apartment houses on them. They're usually come with tenants and a certain amount of rent-paying individuals. Mainridge and Westridge is a property that we bought in the really heart of Houston. And it is a Class C type of property where we are working to renovate and increase rents and therefore boost revenue from the property. The Morgan and Wilcox also in the same kind of area of Houston. We also are working to increase the rents and also the occupancy of these properties. And the other half of our portfolio is, of course, in ground-up developments. The spot at Anderson is a work in progress. Of course, development projects take longer to come to fruition because we're starting from just bare land in some cases, and so these projects are in progress, but they do tend to offer greater returns over the long haul. We're quite proud to present these projects as well because these are the projects that actually add living space to the communities. In terms of what we've done recently, the year of 2021, despite COVID and the pandemic, had turned out to be quite an interesting and encouraging year for us. We've basically put over $1.5 billion of capital into projects. We've hired four new people. Half the team that introduced earlier were hired last year. We've gained over 125 active investors in the projects that we undertake. And we've also worked with municipalities to gain $200 million in public financing, which we are happy to say we're putting forward to future developments in these projects. If you look at other stats, we've seen public improvement districts created to the tune of almost $9 million. So I think our track record speaks for itself. We have been busy acquiring real estate, and I have to say our timing has been quite spectacular because we're seeing tremendous increases in both the value of real estate and also in terms of the rents that these properties can command. So I think that's kind of where we are in terms of an organization. Again, I want to thank everybody for tuning in today. As a reward, so to speak, for you listening to me going on and on, I would like to offer a free ebook or even a physical copy of our book. Please contact us at info@marketspacecapital.com, and I will be happy to personally send you a copy of Prescribing Real Estate. I think you'll find it an interesting read. It's not a whodunit, but I think there are things in there that might pleasantly surprise you.
Fantastic. Well, thank you, Dr. Oishi. Really appreciate you kind of giving us an insight into your journey of going through, as a physician, a full-time physician, as well as a full-time real estate investor. And certainly it's been a pleasure working alongside you over the last several years to build market-based capital to where it's at today. And of course, all of that is due to your experience and your leadership within this organization. So thank you. And I think, you provided a lot of insights into what many of our investors, particularly who are on attending today's webinar, that, they face, right? And that they have additional income that's kind of sitting in their bank account, but they don't necessarily have the time or the resources to dedicate towards real estate, but they understand fundamentally that real estate ought to be a part of your investment portfolio. And in order to have a proper diversified investment portfolio, real estate should be, of course, at the top of that list. And I think you hit the nail on the head when you were kind of explaining the how it's different from stocks or bonds or those types of investment, in that this is a hard asset, right? Something that you can touch and feel. And particularly with everything that's going on right now with inflation, they say that's really the impetus to invest in real estate, to invest in hard tangible assets at that time, because again, through appreciation, you're able to recapture that value. So once again, really appreciate you kind of going through that journey. And, we have a number of questions that are coming in right now, so I think we can kind of go ahead and jump into them directly. And the first question is, how much of my taxes can I typically write off by investing with markets-based capital, or in particular into multifamily real estate? Would you like to take that one, Mas?
Yeah, I think in terms of the way in which we structure our projects, our deals for a multifamily type property, we probably, through cost segregation, can write off something like 50 to 70%, in our first year, so that the K1s that are generated, usually come in with a very nice loss for tax purposes. And I think that's another attractive feature for investors who are high income and high tax bracket.
Absolutely. And this is one of the ways that we can use the current tax laws in order to employ what is known as accelerated depreciation. And that's ultimately what we're doing here. And I think that's one of the unique attributes to investing in multifamily real estate as opposed to investing in normal residential single property, single family homes. I think, this, of course, is the fact that you're able to accelerate depreciation and in some cases take, like you mentioned, 70% in the first year alone is amazing. So I think you had given the example of one of our properties, Main Ridge and West Ridge, in which we employed a cost segregation study. And again, we're able to achieve 64% depreciation, meaning that if our investors had invested $100,000 into that investment, that they would have received a K1 showing a loss, right, in the form of a K1 and the loss of $64,000 that you would then be able to apply towards other ordinary income. So this is one of the unique tools that are available to investors in multifamily real estate. And, let's be honest, these are the tools that the wealthy use to generate more wealth, right? And I think, of course, as a physician and other, professionals who are looking to diversify and add to their real estate portfolio, this is kind of one of the unique attributes that stick out to investing in real estate because you obviously are not qualified to get those same type of tax benefits from investments in stocks per se. So,
Now, investing in securities is very different. And I think in terms of the benefits of investing in real estate, the tax advantages are definitely one of the more attractive features of investing in real estate.
absolutely. So, the next question that is how long are your investments typically? And I'm happy to take that. It's every investment that we make is kind of different, right? Because it has its own underlying business plan. In some cases, we're able to immediately come in and turn around the property and have a trajectory to sell it within the first couple of years. But in most cases, and what we show on our financial models is what a typical 5-year hold looks like. And the reason why we like a 5-year hold is because it allows you enough time to implement the business plan, right? Which is to start with is of course acquiring the property, stabilizing it, implementing your renovation plan. And then once your renovation plan has been implemented, to then typically refinance the property. Now, when we acquire the property, we usually take what is known as a bridge loan. The bridge loan is, usually a little higher on the interest rate, but they have the ability to move quicker and close a loan quicker. So typically in these, when we are acquiring these assets, we have a 60 to a 90-day period. And going through a traditional bank, especially in this market, just simply doesn't make sense, right? Because you don't have the timeline to work with that. So, while a traditional bank can give you the best possible interest rate, in our industry, we usually pay a little bit higher of an interest rate in order to get what is known as that bridge loan. And once upon acquisition, you complete your renovations, you immediately go and refinance into a traditional loan at that lower interest rate. So a 5-year hold period allows us to acquire, to renovate, refinance, and then to cash flow the properties for a couple of years until we decide to sell. However, with that being said, we are living in some very unique times, particularly, here in the state of Texas and in Houston in particular. I mean, we're getting lucrative offers for much shorter time periods. So basically, we're accomplishing the projections of what we estimated that would take 5 years in 1 or 2 years. And of course, in that instance, we have a fiduciary responsibility, to us and our investors to consider those offers.
Absolutely.
So the next question that comes in is, what is the minimum and maximum investment amount in your deals? And again, this is something I'm happy to answer. Typically for our value add investments, we have a minimum investment requirement of $25,000. And on our ground up developments, the minimum investment is right around $50,000. With regards to a maximum investment, we don't necessarily have a maximum amount that we've done. If you are interested in making an investment size of greater than $1 million, we encourage you to contact us. As we would be happy to kind of speak to you as to what we can take. But our average investment amount, I'll tell you, out of our investor network, about 70% or right under 70% are made up of high net worth physicians from all across the country. So you'll see some element of a hospital or medical type of facility. For example, we've done a project in Dallas that's a ground up development. It's directly adjacent to a medical center, to the Dallas Medical Center. Here in Houston, all of our value add assets are in the NRG area, which is, of course, adjacent to the Texas Medical Center. So we tend to like those types of investments if it has that attribute there, because they tend to be in more densely populated areas of the city. And as a result, there's always a demand for those types of products. So not to say that it's required as a part of our investment parameters, but certainly understanding that, our chairman, of course, is a physician, as well as most of our investors are physicians. It kind of adds that extra layer of comfort there as well. And then, the final element to add to that is that, through these investments, of course, the goal is understanding that since most of our investors are physicians, we try to host and these types of webinars where the educational content is really geared towards that physician audience, because ultimately that's who we're serving, right? And while we have other investors that are, of course, non-physicians, we understand that being our biggest investor network and database, that a lot of our materials, again, are kind of targeted towards that physician audience. Next, the question came in is, when do investments start to typically see cash flow? Moss, would you like to take that one?
Yes, I think it really depends on the project somewhat, but I'd say as a rule of thumb, our value add projects, we would probably expect cash flow within about 12 to 18 months. About a year or a year and a half would be a good estimate, a good rule of thumb. For ground up developments, obviously that would take longer, because construction, time periods, I'd say probably about 2.5 years to 3 years would be a good estimate. But again, it's not really, how soon do these investments start to pay off. It's, looking to the future. It's what kind of returns do they generate, and what kind of tax advantages do they have. I think that's really more of, where we have our focus.
Yeah, absolutely. And I think, one important point to add there is that, between the value add strategy, which typically is seen as more or less risk averse, right? Because there's already an existing tenant base. So it's therefore cash flowing. So typically in those assets, we of course see distribution starting sooner. As you mentioned, in the fastest case scenario, we can see it starting at 6 months. Typically that, average is right around the first year that you'll start seeing that cash flow coming back through distributions, which of course we do on a quarterly basis. And, it's a simple explanation, right? Of course, as tenants are paying their rent every month, we're collecting that rent. And that rent, our property management company is essentially managing the operations and the rent collections. We pay off all of the operations, the expenses, and essentially whatever is left over goes into a bucket. And on a quarterly basis, we do distributions to our investors from that bucket. Now, all of our investments are structured in such a way that the investors are entitled to 100% of those cash flows until they have gotten 100% back of all of their invested capital, as well as all of the accrued preferred returns. So on our value add investments, those preferred returns typically are around 8%. On our ground up developments, those preferred returns range, from 8 to 10%. And so what that means is, let's say, for example, if you were to make $100,000 investment with markets-based capital, is that on an annual basis, at minimum, that $100,000 is earning $8,000 per year. And that is, of course, accumulating, right? It's accruing, and it is paid out before us, the sponsors, are paid any money. So on a value add deal, again, typically you start seeing distributions come sooner. But on a ground up development, while there's no cash flow happening during construction, therefore no distributions are going out, the value that you're creating in those investments is much more than you would be doing on a value add investment. Again, you're taking a piece of dirt, you're bringing the architects, the engineers, and you're bringing together this whole development, and now you have a cash flowing asset that with people living there and operations. So you've created an enormous amount of value in that regard. So when you go to refinance a ground up development, you're typically getting a significant portion of your cash back out of that deal, because again, in that refinancing, just like your home, the same exact principles apply, in that you bought your home at a certain value. After a certain amount of years, it's appreciated in value, and therefore you go and you refinance, and upon that refinance you get a cash out. The same exact principles apply to multifamily real estate investing. And so in a ground up development, typically that cash out is enough to take care of your initial investment. After that, it's just then cash flowing the asset. So once again, to summarize, on a value add deal, typically less risk averse, but the total returns tend to be on the lower end, in the low 20% range. On a ground up development deal, it tends to be a little bit more riskier, right? Because you're going a couple of years without cash flow. You're going through the construction process. But those tend to have higher returns, usually projected in the 26 to 29% on the conservative end. But again, you're not getting your cash flows till later. So in all of these real estate investments, whether it's a value add or whether it's a ground up development, that kind of point to where you get your investment back and you start getting those cash flows happens right around month 24, month 30. So 2 to 2.5 years is kind of where you think you can kind of start getting your investment back out of the deal. So with that being said, let's go on to the next question. What makes you guys different from other syndicators? And I'd be happy to take that one on. Typically, this question, is a great question. I love that you asked that, because, what we specifically focus on is a data-driven approach. And that's what we really feel sets us apart from what our competitors, are doing in the market. And look, we understand there's the front side of it in terms of, locating an asset or a site, and we've created our own internal kind of proprietary model, which we call it the econometric model, which again is just a fancy way of saying that we collect a bunch of pieces of data, about 28 pieces of data, the same thing that everybody else gets in terms of income growth and population growth, but we really get into the nitty gritty of it. And we look at crime rate statistics, education grade, and we use that to really, score a site. And part of that is selfish, in that we don't want to, waste unnecessary time or money on a site that just doesn't fit our investment parameters. But part of that is also so that we leave no stone, unturned, right? Where we basically know every single part of it. And we have a formal process that we've created internally, in which we have a investment committee. We will have our market analysts kind of run down the econometric side. We have our director of acquisitions create the financial model. These are presented to us in our investment committee, and ultimately that's how we make our decision. So I would say that's kind of the differentiating factor between us and other syndicators, is that we really follow the data, and we use that to make our decisions. Another question came in with regards to telling us more about our asset management process. This is one of the things that we pride ourselves on, in that we provide quarterly reports. On a quarterly basis, we provide a thorough summary of how the asset is performing. And in addition to that, we provide a financial summary. So we work with our CPAs here in Houston, and essentially those two items are included and sent out to all investors on a quarterly basis. We do not currently do in-house property management, market space capital. We usually have partners that we work with that handle that part of the business. But again, we ourselves manage the asset management part of the business. And specifically, Kevin Sabuni in our office is the director of our asset management and currently kind of oversees, the operations of these assets in the Houston and Dallas areas. When do you know if it's a time to sell or hold? That is a difficult question. And the reason being is because we usually look at two things. One is market conditions, which I will tell you again, the Texas market and Houston in particular is very strong right now. And as a result, we've been seeing, just the returns and the offers of what we've been seeing in the market are unexpected, right? And it just continues to climb up. And this is a result of a lack of supply that's here, as a combination of Texas just being a great market right now, and that we've been the beneficiary of the exodus of people moving from California, New York, and Illinois, right? And so as a result, we've been the beneficiary of that, and it's driven up real estate prices. And so, right now is a lot of sponsors, a lot of our friends in the industry are selling because they think that this is an opportune time to do so. We do not see, part of our job is to really kind of foresee where the multifamily industry is going. And in the Houston market in particular, we do not foresee anything really in terms of a stumble. Obviously, there are outside factors. There's a war going on, for example, and these different elements, but directly with its direct impact on multifamily, and we don't see the market slowing down anytime soon. The next question came in as, yes, Dr. Balda, we will definitely have a recording of this webinar that's going to go out to all investors tomorrow. So you'll certainly just be on the lookout for that as well. Will the commercial real estate valuations be depressed in the rising interest rate environment that just started? Wage increases are not keeping up with the inflation. So will NOIs be squeezed for these properties? That's an excellent question, Rao. And Dr. Oishi, why don't I turn that over to you to kind of give us more of a high level insight, as to the overall economic condition of what we see in the multifamily market.
Right. I think it really depends on how you look at the market. If you look and focus on the macroeconomics, certainly increased interest rates tend to depress the price of real estate because it makes it harder to acquire. On the other hand, we're looking at inflation rates that I haven't seen since I was a child, which is a long time ago, quite frankly. So in terms of real interest rates, we're actually looking at negative rates right now. So that's the macroeconomic picture. You can argue one way or the other. I think with inflation being on the minds of so many people, there's going to be somewhat of an asset preference for investors to go into real estate rather than bonds or other securities. And that's just the macroeconomic picture. I think fundamentally though, we have to look at each property as an individual asset. And that's kind of the way we approach our investments. We don't say, well, a multifamily property in Houston is the same as a multifamily in Seattle or any other city. We evaluate each property on its own merits, which means that it's subject to local supply and demand. And as far as the Texas market is concerned, we're seeing very favorable demographics. A lot of people are moving to not just Houston, but also Dallas and other cities in Texas. So that can't help but drive up demand. Nationally, yes, there may be some blunting of the increases in rents over time. But as far as specific markets, individual markets are concerned, they have their own local supply and demand issues. And I think that's where we see our approach to crunching the data, looking at the numbers, and determining whether or not investments will continue to perform in the future as our strength. We're able to do that, I think, with a fair degree of comfort because we've developed a very nice econometric model, and so I think that's our strength, and we believe in our ability to find properties that will continue to outperform the rest of the market.
Sure. Yeah, absolutely. Great point, Moss. And Rao, to answer your question specifically, I mean, we're seeing commercial the exact opposite of what your question is implying. That will commercial real estate valuations be depressed in a rising interest market? I mean, the demand here, particularly in the Texas market, has just increased the valuations of what these actual assets are worth. Inflation kind of has an inverse effect because the material prices are increasing, and obviously all these materials are going into our actual properties, right, to develop. So even in the last year alone, I mean, we did the spot at Myra Park, the property that we have in Dallas, the ground up development of 250 units. We're about 20% through the construction process on that project, and we've already seen such dramatic volatility. And I wouldn't say volatility because there's not really going downwards. There's only a trajectory of it going upwards. But, you're seeing such a dramatic shift in the rent prices there, the rent increases. So, we went back and got the project reappraised, of course. So this is a project that, again, initially what the stabilized appraised value is right around $66 million. But recently, as of 2 weeks ago, the newest appraisal showed the value closer to $76 million. So you can see that we got a significant bump in just because of the rent increases that are being projected in the market. In addition to that, another kind of real example for you is a property that we recently acquired called Huntington and Excelsior. Some of the investors that are on this call today are actually invested in this deal. And one of the things that we're seeing now is initially, we acquired this property and they were getting right around 96 to 98 cents per square foot. Again, this is a Class C asset. By doing our renovations, we had projected modest bumps in the rent to get around $1.08 per square foot. We have put these onto the market and we are now getting $1.26 per square foot. So that just kind of shows you the demand that's being driven right now for units in the Houston area. And basically, again, we're charging $1.26 for something that just a couple of months ago they were charging 96 cents. That's an extra for those of you kind of working out the math. That's an extra $250 in rent that they're paying a month that we've been able to collect. So it's just an amazing story. So I would say that Rao, to answer your question again, we're not really seeing the impact. At some point, maybe we will, but this is a very different situation compared to 2008. We do not see subprime mortgages issues happening. We believe that the subsequent administrations have put safeguards into place to hopefully foresee these types of issues. But certainly on the multifamily side of the business, we're not seeing any type of reverberating impacts there. So the next question that came in was, do we have any new projects that are open for investors to get into? Currently, we do not. We just closed our latest offering, as Dr. Oishi mentioned. It's called the Tri-County Mall, which we closed on last Monday. We typically do about 6 to 8 investments a year. And so, we look at about 100. I think last year we did the count and we had actually underwritten about 126 different projects around the country. And of those, again, we only choose to invest into 6 or 8 of those. So we're very selective in that investment process, but we estimate the next value add investment that we will make here. We're currently underwriting of a variety of projects, but we think it'll be in the second quarter, between the second and third quarter of this year. So stay tuned for those updates. To what extent do we invest in deals along with our other investors? So we, the partners and principals of Market Space Capital, myself, Dr. Oishi, and David Rodarte, we invest our own money alongside of our investors in every single one of these deals. Typically, the minimum is 5% of the total equity that's required that we will put in from our pockets. And in some deals, it's been as up to 10% of the total equity. So again, we feel it's important to have our own skin in the game. And so in every one of these deals, of course, that is the case. And then finally, what are the fees associated with investing? So there's no fee that's typically involved with investing with markets-based capital. We do use a investor portal, so we would create an account for you. You would have access to this investor portal 24/7. You have the ability to actually make investments on that investor portal, reviewing the actual offering, and then going through and signing and executing subscription docs. After that's done, typically your quarterly updates are there. And then once your distributions are made, your distributions will also be reflected on your investor portal. And so let's see the other questions. Where does MarketSpace invest in primarily? Dr. Oishi, would you like to take that and kind of close us out here?
Yeah, I think the bulk of our investments are right here in our home state of Texas. Investments and real estate, it's all local. We know more about these properties and the towns and communities that they are in than anybody else outside the state. So, we have an informational advantage when it comes to these things. That's not to say that we won't invest in other states, of course. We look at the numbers and we assess each property on its own merits. But I'd say, I think we're all proud to be Texans here, Sahel. So, we tend to gravitate towards that which we are more familiar with and that which, we can keep an eye on.
Yeah. And we currently obviously have investments primarily in the Houston and Dallas areas. Of course, now we have one in Cincinnati, Ohio. In the past, we have made investments into Las Vegas, into Kansas City. But of course, we like to say that in our own backyard, there's enough business right here, right? So why go out outside of it? And Dallas and Houston are actually one of the hottest markets and have been one of the best performing real estate markets over the last decade. And so for that reason, we are really focused here. But of course, when there are advantageous opportunities like the Tri-County Mall that come along, we will, of course, consider those other locations around the country. And then the final question we had here, Miguel, I didn't want to get off. I know we're running out of time here, but did want to get to your question with regards to how our group differentiates from other real estate funds that are available. And Miguel, I want to kind of make an important distinction here in that this is not a real estate fund. Well, what fund will typically do is take a bunch of different properties together, and then you invest in that fund that owns a bunch of different properties. We are slightly different in that we are more selective. Again, we are looking at individual properties only, and we do what are known as syndications, where we basically, again, out of 100% of the total investment price, right, the cost of the project, usually 70% will come from a lender. Then the remaining 30%, again, as I mentioned, we, the sponsors, will put in 5 to 10% from our own pockets. And then that remaining 20 to 25%, we go and we raise from outside investors such as yourselves, usually at a minimum of, again, $25,000 or $50,000 increments. The average investment size that we have today is right around $225,000 on our investor portal. But we specifically go deal by deal. So it's individual syndication. So by making that investment, you're investing in that one property and not a group of properties. But the other important distinction to note here is that, again, when you're making investments with sponsors like us, the returns are projected to be higher, right? Because we take a little bit more risk, right? We're investing in Class C assets where there's kind of more meat on the bone, more value to create there. Typically, these funds, they're more risk averse. So they're only going to invest in, these real estate investment trusts that they're otherwise known as REITs. They'll invest in only core Class A assets that are amazing, and they have excellent high credit tenants, but they have lower returns. But those returns are, again, more reliable and consistent. So you're essentially paying for that. So your returns typically on a REIT investment might be 8, percent per year. Whereas again, when you make an investment with markets-based capital, if it doesn't pencil out to right around 20%, then we don't even want to make the investment, right? So we're again looking for more opportunities, and it has to at least return a minimum of 20% in order for us to make sense for us to go into that investment. So again, that's slightly kind of the difference between what a real estate fund is as opposed to what we are doing now as a real estate syndicator. Now, in the future, we might have plans of putting a portfolio of properties together and kind of creating a fund of sorts, but just kind of wanted to give you that distinction in terms of what we're looking at in return.
I think that's a great point, Sahil. I think what we offer is, tailor-made investments. Number one, investments that we have thoroughly vetted, and absolute transparency as to where your money is. Okay, REITs are like mutual funds. I used to invest in mutual funds too, but from one day to the next, I had no idea where my money was. I had no idea what my money was doing. I get a quarterly report every once in a while from the mutual fund company, but by the time I received it in the mail, it was already out of date. So that's one way of investing. I'm not saying it's wrong, but it's no fun. I think there should be some joy in investing as well, and I think that's kind of what we like so much about our approach towards investments.
Yeah, and I think Moss, that you said it perfectly earlier, right? It's not necessarily about investing for returns, right? Ultimately, that's what we're running a business here, and so there's that component of it, but there's also the community impact component of it, right? And that's really what sets us apart. And specifically here at Market Space Capital, our mission statement is to create communities that are affordable, inclusive, and sustainable. And we believe that aligns with the goals of what we're trying to achieve as a society, right? And we are kind of doing that. We're impacting people's lives by giving them a better place to live. And so with that, we really appreciate you all taking the time to join us this evening. On behalf of Market Space Capital and Dr. Oishi, and we just want to extend our thanks to all of our investors who instilled their trust into us. Many of you, again, are across the country whom we've never personally face-to-face met, yet you took that chance on us, and that's the only reason why we have been as successful as we have been today. So once again, thank you all for joining us, and wish you a good evening. Bye-bye.
Thank you.